Hello students, welcome to the lecture on hire purchase and installment purchase system. And after the lecture, we will be able to learn the following objectives. Explain the nature of hire purchase agreement, define the ascertainment of total cash price, understand about ascertainment of interest, explain the nature of hire purchase and leasing transactions, discuss the Hire Purchase Act, explain in brief about keeping records. Let's start with a brief introduction. An increasing demand for better life, the consumption of goods has been on the expanding scale, but this has not been backed up by adequate purchasing power, transforming it into effectual demand, that is, actual sale at set or settled prices. This has created the market for what is called hire purchase. When a person wants to acquire an asset but is not sure to make payment within a stipulated period of time, he may pay in installments if the vendor agrees. This enables the purchaser to use the asset while paying for it in installments over an agreed period of time. This type of a business deal is known as hire purchase transaction. Here, the customer pays the entire amount either in monthly or quarterly or yearly installments, while the asset remains the property of the seller until the buyer squares up his entire liability. For the seller, the agreed installments include his interest on the assets given on credit to the purchaser. Therefore, when the total amount is paid in installments over a period of time, it is certainly higher than the cash down price of the article because of interest charges. Obviously, both the parties gain in the bargain. By virtue of this, the purchaser has a right of immediate use of the asset without making downright payment from his own. By this, he gets both credit and product from the same seller. From seller's viewpoint, he derives the benefit by increase in sale, and also he recovers his own cost of credit. Let's talk about hire purchase agreement. Under the hire purchase system, the hire purchaser gets possession of the goods at the outset and can use it, while paying for it in installments over a specified period of time as per the agreement. However, the ownership of the goods remains with the hire vendor until the hire purchaser has paid all the installments. Each installment paid by the hire purchaser is treated as hire charges for using the asset. In case he fails to pay any of the installments, even the last one, the hire vendor will take back his goods without compensating the buyer. That is, the hire vendor is not going to pay back a part or whole of the amount received through installments till the date of a default from the buyer. Special features of hire purchase agreement. There are some features of hire purchase agreement. Possession. The hire vendor transfers only possession of the goods to the hire purchaser immediately after the contract for the hire purchase is made. Installments. The goods are delivered by the hire vendor on the condition that the hire purchaser should pay the amount in periodical installments. Down payment. The hire purchaser generally makes a down payment, that is, an amount on signing the agreement. Constituents of hire purchase installments. Each installment consists partly of a finance charge, interest, and partly of a capital payment. Ownership. The property in goods is to pass to the hire purchaser on the payment of the last installment and exercising the option conferred upon him under the agreement. Repossession. In case of default in respect of payment of even the last installment, the hire vendor has the right to take the goods back without making any compensation. Terms used in hire purchase agreements. Hire vendor. Hire vendor is a person who delivers the goods along with its possession to the hire purchaser under a hire purchase agreement. Hire purchaser. Hire purchaser is a person who obtains the goods and rights to use the same from hire vendor under a hire purchase agreement. Cash price. Cash price is the amount to be paid by the buyer on outright purchase in cash. Down payment. Down payment is the initial payment made to the hire vendor by the hire purchaser at the time of entering into hire purchase agreement. Hire purchase installment. Hire purchase installment is the amount which the hire purchaser has to pay after a regular interval up to a certain period as specified in the agreement to obtain the ownership of the asset purchased under a hire purchase agreement. It comprises of principal amount and the interest on the unpaid amount. Hire purchase price. It means the total sum payable by the hire purchaser to obtain the ownership of the asset purchased under hire purchase agreement. It comprises of cash price and interest on outstanding balances.
HP stands for Hire Purchase. Hire Purchase is a finance product that allows you to budget accurately by giving you a fixed interest rate and fixed monthly payments. The deposit and the length of the contract in a hire purchase agreement can be easily adjusted, letting you find the monthly payment that fits your budget. Because the vehicle acts as the security for the finance arrangement, other forms of credit will remain available to you for future use. A hire purchase facility can be settled at any time, and there are no financial penalties to pay if you decide to settle the agreement early. At the end of the agreement, you will take full ownership of the vehicle.
Ascertainment of total cash price. We know that the basis for accounting in the books of the hire purchaser is the total cash price. Sometimes the total cash price may not be given. For the purpose of ascertaining the total cash price, we can use any of the following methods according to the need. Calculation of total cash price without using annuity table. In this method, the interest included in the last installation is to be calculated first with the help of the appropriate formula. For example, in a hire purchase transaction, apart from down payment, 4 other installments are payable. The interest will be calculated first on the 4th installment, then on the 3rd installment, then on the 2nd installment, and lastly on the 1st installment. Interest on down payment will be nil. In this connection, it should be noted that the amount of interest will go on increasing from the 4th installment to the 3rd installment, from the 3rd installment to the 2nd installment, and from the 2nd installment to the 1st installment. We know that interest is to be calculated on the outstanding balance of cash price. In this case, we will have to calculate the interest with the help of the total amount due on hire purchase price, since the cash price is not known. For the purpose of calculating the interest, the following steps should be followed. Step 1. Calculate the ratio between interest and the amount due with the help of the following formula. Ratio of interest and amount due equals to rate of interest 100 plus rate of interest. Step 2. Calculate the interest included in the last installment by applying the following formula. Interest equals to total amount due at the time of installment into the ratio of interest and amount due as calculated in step 1. Step 3. Subtract the interest as calculated in step 2 from this installment to get the amount of outstanding cash price at the time of last installment. Step 4. Add the cash price calculated in step 3 to the amount of installment due at the end of the 3rd year. Step 5. Calculate the interest on the entire sum, cash price included in the 4th installment plus amount of 3rd installment. Deduct this interest from the total amount due at the end of 3rd year to get the outstanding cash price at the time of 3rd installment. Step 6. Add the cash price calculated in step 5 to the amount of installment due at the end of the 2nd year. Step 7. Calculate the interest on the entire sum so obtained in step 6. Deduct this interest from the total amount due at the end of 2nd year to get the outstanding cash price at the time of the 2nd installment. Step 8. The cash price calculated in step 7 to the amount of installment due at the end of 1st year. Step 9. Calculate the interest on the entire sum so obtained in step 8. Deduct this interest from the total amount due at the end of the 1st year to get the outstanding cash price at the time of the 1st installment. Step 10. Add the cash price calculated in step 9 to the amount of down payment, if any. The sum so obtained will be the total cash price. Calculation of total cash price with the help of annuity table. Cash price equals to down payment plus present values of installment. Present value of installment is calculated as, if present value of an annuity of $1 for a given period at given rate of interest is given, present value of installments equals to annual installments into present value of an annuity of $1 for a given period at given rate of interest equals to annual installment into 1 plus r n minus 1 r 1 plus r n. If annuity to recover $1 during a given period at given rate of interest is given, annual installment into r 1 plus r n 1 plus r n minus 1.
Touch Manufacturing is considering a rearrangement of its manufacturing operations. A consultant estimates the rearrangement should result in after-tax cash savings of $6,000 the first year, $10,000 for the next 2 years, and $12,000 for the next 2 years. Interest is at 9%. Assume the cash flows occur at the end of the year. Calculate the total present value of cash flows. When we put that on paper, we see that the first year savings is $6,000, second, $10,000, third, $10,000, fourth, $12,000, and fifth, $12,000. What we'll need to find the total present value of cash flows is first the after-tax savings amount, second, N, which is the period savings will be received, third, I, the interest rate, and fourth, the present value of dollar factor for each year savings were received. How many payments per year? It says assume the cash flows occur at the end of the year, which means that they are once a year and that it is an ordinary annuity. This also helps in finding the correct interest rate. The interest rate being annual, that means that it can stay the same because it's only going to be made once a year. So that will remain 9% for this particular problem.
Let's study the ascertainment of interest. We know that the hire purchase price consists of two elements, cash price and interest. Cash price is the capital expenditure incurred for the acquisition of an asset, and interest is the revenue expense for the delay in making the full payment. Ascertainment of any of these two gives the answer for the other. Example, if we ascertain the total amount of interest, it becomes very simple to ascertain the cash price just by deducting the amount of interest from the hire purchase price. Interest is charged on the amount outstanding. Therefore, if the hire purchaser makes a down payment on signing the contract, it will not include any amount of interest. It should be noted that though the installments of a hire purchase agreement may be equal, the interest element in each installment is not the same. At the time of calculating interest, students may face the following two situations. When the cash price, rate of interest, and the amount of installments are given, and when the cash price and the amount of installments are given but the rate of interest is not given. Now let us consider the above two situations. When the cash price, rate of interest, and the amount of installments are given, in this situation the total amount of interest is to be ascertained first. It is the difference between the hire purchase price, down payment plus total installments, and the cash price. To calculate the amount of interest involved in each installment, the following steps are followed. Step 1. Deduct down payment from the cash price. Calculate the interest at the given rate on the remaining balance. This represents the amount of interest included in the first installment. Step 2. Deduct from the interest of step 1 from the amount of first installment. The resultant figure is the cash price included in the first installment. Step 3. Deduct the cash price of the first installment, step 2, from the balance due after down payment. It represents the amount outstanding after the first installment is paid. Step 4. Calculate the interest at the given rate on the balance outstanding after the first installment. Deduct this interest from the amount of the second installment to get the cash price included in the second installment. Step 5. Deduct the cash price of the second installment, step 4, from the balance due after the first installment. It represents the amount outstanding after the second installment is paid. The nature of hire purchase and leasing transactions. The nature of hire purchase are lease transactions. In the eyes of English law, a lease of goods is a hire contract by whatever name it is called. Essentially, equipment is hired from the lessor to lessee so that the lessee can use the equipment in exchange for payment of rent. The lessee never acquires ownership of the equipment but only has the use of it. Termination. A finance lease normally does not permit the lessee to terminate the agreement before the end of its term, or if it does not permit this, it will only permit it upon the basis that the lessor is put back into the financial position that it would have been in had the agreement continued for a full duration. An operating lease, by contrast, is likely to be capable of being terminated at much shorter notice. Accounting treatment. From a lessee's point of view, it is usually important to ascertain whether a lease is treated in its accounts as being an operating lease or a finance lease. When structuring leasing transactions, it is frequently relevant to refer to the relevant accounting standards or, in appropriate cases, to take advice on the accounting treatment. Hire purchase transaction. A hire purchase transaction, in essence, is a lease of goods from a lessor to a lessee for the lessee's enjoyment in exchange for the payment of rent. Upon all the rent payments being made, the lessee will have an option to purchase the equipment for a nominal sum. Conditional sale agreement. A conditional sale agreement is an agreement for sale of the item of equipment under which title remains with the seller of the equipment until the purchase price of the equipment has been paid in full and the buyer has complied with the other provisions of the conditional sale agreement. We shall now discuss the Hire Purchase Act. This act may be cited as the Hire Purchase Act. This act shall not have effect in relation to any hire purchase agreement, credit sale agreement, consumer's bill of sale or conditional sale agreement made before the 1st October 1974. In this act, action, buyer and warranty have the meanings assigned to them respectively by the Sale of Goods Act. Buyer in relation to a conditional sale agreement means the person who agrees to purchase goods under the agreement and includes a person to whom the rights or liabilities of that person under the agreement have passed by assignment or by operation of law. Cash price in relation to any goods means the price in which the goods may be purchased by the purchaser for cash. Conditional sale agreement means an agreement for the sale of goods under which the purchase price or part of it is payable by installments and the property in the goods is to remain in the seller, notwithstanding that the buyer is to be in possession of the goods until such conditions as to the payment of installments or otherwise as may be specified in the agreement are fulfilled. Consumer's bill of sale has the meaning assigned to it by Section 35. Contract of guarantee in relation to a vending agreement means a contract made at the request, express or implied, of the purchaser, either to guarantee the performance of the purchaser's obligations under the vending agreement or to indemnify the vendor against any loss which he may incur in respect of that agreement, and guarantor shall be construed accordingly. Credit sale agreement means an agreement for the sale of goods under which the purchase price is payable by 5 or more installments, not being a conditional sale agreement.
All businesses have to keep accurate financial records. Avoid a possible £3,000 fine by keeping good, up-to-date records. Well-kept records also help businesses run more efficiently. Here we'll explain how having an effective record-keeping system will help you run your business better and save you time and money. Keeping good records is a key part of running a business. A good rule of thumb is to keep all the information that supports the figures on your tax return for at least 6 years. This means you must record your takings and expenses and keep copies of invoices, receipts and bank statements. But you'll find that doing more than the minimum required by law makes good business sense. Keeping a cash book shows money going into and out of your business, which helps you to keep a close eye on cash flow. And using sales and purchase ledgers allows you to keep track of how much customers owe you and how much you owe your suppliers. With good business records, you'll be confident you're paying the right amount of tax. They'll help you convince a bank or another lender that your business is sound. And they'll help you to budget, so there are no nasty surprises when it's time to pay your tax bills. We've talked about your legal obligations and the benefits of keeping good records. Now let's look at how to keep them. Computerized record systems have lots of advantages over paper-based systems. Even simple spreadsheet packages let you add, delete, change and share data. They also do the calculations for you, which cuts down on errors. And if you choose full accounting software, you can use it to file your tax returns online quickly and easily. You'll be able to do other things too, like creating reports that can help you run your business more effectively. If you keep computerized records, make sure you have a way of saving or backing up the information and storing it securely off the premises in case your system fails. Computer failure isn't a valid reason for having no records. Of course, having some paperwork in your business is unavoidable. Things like invoices and receipts need to be properly filed so you can easily create your business records from them. Good record keeping is an essential part of running a business. It's a legal requirement and it can help you run your business more efficiently.
Keeping records. The IRO requires us to keep sufficient records to enable our accessible profits to be readily ascertained. All records must be retained for 7 years from the transaction date. It is an offense not to keep adequate records. We can be penalized for not doing so by being fined up to $100,000. There are also many other sound reasons why we should keep accurate business records. Here are some. Accurate records allow us to be in better control of our business by helping with financial planning and decision making. We portray a more professional image that makes it easier to deal with our bank. Appropriate records enable us to file an accurate profits tax return. The cost to us of an IRD audit are reduced if all of the necessary records are readily available. Some ideas for record keeping. Business records which must be kept include documents which provide a record of business transactions or which enable these transactions to be traced and verified through the accounting system from start to finish. These include invoices, receipts, cash register tapes, banking records, checkbooks. The essence of good record keeping is good bookkeeping. Efficient bookkeeping will save time and money in the long run. Here are some tips to help improve the efficiency of bookkeeping. Make bookkeeping part of regular routine. Once we have established a routine, we will find that our work through our books more quickly. Keep our bookkeeping up to date. Keep our books in an organized manner. We will work quicker if we can easily access the information we need. Look for ways to improve our bookkeeping. Do not leave things until the last minute. Now, in the end, let us summarize what we have learned in this lecture. When a person wants to acquire an asset but is not sure to make payment within a stipulated period of time, he may pay in installments if the vendor agrees. The ownership of the goods remains with the hire vendor until the hire purchaser has paid all the installments. The leasing industry has developed a variety of names to describe different leasing transactions. A finance lease is one in which the equipment is let out on hire for a period of time approximately equal to its economic life, and the lessee takes on all responsibilities for maintaining the equipment. A hire purchase transaction, in essence, is a lease of goods from a lessor to a lessee for the lessee's enjoyment in exchange for the payment of rent.